Introduction to Alternative Capital.
Hi everyone, thank you for joining us for another panel here. This is Introduction to Alternative Capital. The simple fundamental behind this one is oftentimes, especially for first-time founders who have never raised before, they think that there's two ways of getting money. There's high net worth individuals or angel, and then they heard about this thing called venture capital or institutional venture capital. But there's a lot more optionality out there, and this panel is about to explore how those options actually exist. So I'm going to go down the line, starting right here. Please introduce yourself, the firm, the fund, and a little bit about it, and then we'll go down that way and start with questions.
Sure. I'm Omid Akavan, Managing Director at Anthro Ventures. We focus on clinical through commercial stage, MedTech, health tech. Background on the firm, I used to be at MVM Partners, and I saw a need in the market for companies that are kind of in this phase, what they often call the valley of death in MedTech, which is companies that are starting clinical studies and need capital to basically bridge through to commercialization. And so we, through our family office and with some other families, have basically been doing deal-by-deal investments, so syndicated investments, and been doing that for the last 7 years.
So I'm Ken Nelson, partner in the MedTech Advantage Fund, and we are investing only in alumni companies of MedTech Innovator. MedTech Innovator is the largest digital health and medical device startup accelerator globally. I was involved in a couple other ones and still am. One's called Health Wildcatters in Dallas, much smaller scale, and I'm invested in their funds, and another one called Grand Central Tech, and the fund's called Company Ventures out of New York City. And so we kind of looked at those models and said, why don't we do this on a bigger scale with the largest accelerator globally? And so that's what we're doing.
My name is Humberto Matsuda. I've been doing venture capital for over 20 years now. 15 of those managing my own funds, doing early stage investments in Brazil. Throughout this time, I managed several funds. I've been working with corporations and family offices for the last few years. We've been investing from seed stage all the way to Series B. We do also invest in private equity and also real estate. We are not industry focused, but we can make several different structures of investments, and I represent several different institutions, sometimes as a GP, sometimes as an LP, and even sometimes helping families to donor money and help NGOs. So the idea is to provide you a little bit of my experience, not only in Latin America, but also in North America and Europe.
My name is Matt Jacobs. I work for the Cedar Street Group. It's the family office of Paul Francis, who was the 6th employee and first CFO of Priceline.com. We primarily focus on early stage technology companies with a focus on kind of healthcare delivery and clinical development. So we're based out of New York and generally focused in the US, but we are somewhat agnostic to the location of it.
My name is Mercedes Town. I work for BOM. We're a regional development agency, which means we're a Dutch government-backed fund. We have about 500 million euros under management currently. We invest in companies that have strong strategic ties to the region that can benefit from, but also add to the ecosystem. For life sciences and medtech, we invest in stuff like surgical robotics, imaging, biomaterials, new therapeutics, but also healthcare system improvements. We also do fund-to-fund investments, and we are an LP in most of the Dutch healthcare funds. We've backed Certa, which developed Keytruda, but we also backed Precise, which was exited to Zeiss. All the funds are reinvested. We operate, we benefit from the ecosystem around Eindhoven, which is where Philips is based.
All right, I'm Alberto. I'm moderating this panel, and maybe I'll start with a question. Go for it. Fantastic. I guess the first question I have when I was an operator in a startup, every different investor requires a different pitch. At a point, I had 100 different versions. So if you could share a little bit, what is that it's important on your case, that would be fantastic for the audience.
While you're looking at me, I'm happy to take the first answer. So for us, like I said, what's important is, can you benefit from the ecosystem and can you bring something to the ecosystem? So a lot of the companies obviously originate in our region, and then the link is obvious. But to give you an example, we've also invested in a company outside of the Netherlands, which has a very strong direct strategic link to the supply chain in our region. So there is a manufacturing company in our region that did some of the R&D, but manufactures the device and is also co-investing with us. So there's direct growth. It falls within our focus. It's surgical, it's imaging. So then it made sense. So we get a lot of CEOs approaching us, asking us to evaluate their decks, but don't make any effort to explain any regional link. You should see us as your customer, right? You're trying to sell me something. You're trying to sell me equity in your company. At least tell me why I should buy it.
So I think one of the core things that we look at from the outset is, what is the problem that you're solving? Is it a big enough problem to justify our attention? And then do you have an innovative or disruptive solution to actually address that? So that's table stakes. You need to have that as part of any pitch that you're putting together. I think for Mercedes' point, tailoring the pitch deck and the story that you're telling to the audience matters. It's going to be a very different story to Mercedes than it would be to myself. As a family office, we have a lot of latitude. We're a very small shop with 2 employees, including myself and the owner. So we have a lot of latitude in terms of what we invest relative to a traditional fund that has very strict investment parameters. So the way you tell your story is going to be different in that regard. And then I think one of the things that I really look for, and you're going to get differing opinions on this, some people want to see hockey stick growth and they want to see that you are shooting for the moon with what you have. I am very much based in reality, and I want to see what are the steps that you are going to take, what's your critical path to get from here to there, to your de-risking milestones, the things that you need to achieve for this to be a reality, which in another way of saying that is, what do I have to believe for you to be successful? And that in itself becomes a stress test of, do I follow the logic that you're presenting, or do I kind of see red flags?
I think that's a very complex question. There's so many different answers to that. As someone who's evaluating opportunities, it depends on what kind of companies we're talking about, early stage opportunities versus late stage versus private equity. As an angel, it's different as a VC, which is different as someone who's actually co-investing with another fund, right? So I guess the best way to answer that and turn into an advice for entrepreneurs in the audience would be to try to understand to whom you're talking to and shape your pitch, understanding not only who is the person, the background of the person. Someone who comes from IB will have different mindset for evaluating a business as opposed to an engineer or someone who comes out of being a former entrepreneur, right? So understanding to whom you're talking to makes all the difference, and also understanding what kinds of investments that fund, angel, or whoever the investor is doing also is a big clue about what kind of opportunities they're pursuing, looking for, and what they're really interested about. So if you have the opportunity eventually to talk to other entrepreneurs backed by the very same investor, it also could be a good way to source intel about what are the key factors that will convince or have convinced the same investors in other opportunities.
So before I answer the question, I'm going to talk about something a lot more interesting. Wake the crowd up a little bit. So there's one person here, and they're not in the room, which is why I'm telling the story, so you can talk to him about it later, who's an actual Knight of Malta. And so I think when you guys see Greg Madden next, go ask him about him being a Knight of Malta. This is a true story, right, Giovanni? It's true. but very interesting. And so there's parts of this building that are tied to the order that he's a knight of. So that's your fun fact for the day. But to answer the question, I think people, passion, perseverance, those three aspects are things that we're looking at a lot. For us, the company has to have gotten into MedTech Innovator first, the accelerator program. That program gets about 2,000 startups a year globally that try to get in. It's medical device, digital health, diagnostics. We pick a couple hundred to pitch at different events across the world, a couple in the US, one in Dublin, and I think one in Singapore. And then from those couple hundred that pitch, we pick 100 to go through. But what I can tell you from judging those events, and I think you guys have been judges at different events, and some others on the panel have probably been involved, we really talk about the people a lot. We talk about the founder a lot. I think the kiss of death is if they're not coachable. But we really do look at the person. We look at how they tell the story, how passionate they are about what they're trying to do, like what's their why. And I think that goes into it, a lot of the decision that gets made. So I think, again, it's people, it's passion. How passionate are they in general? And then how passionate are they for what they're doing and their why? And then perseverance. Do they have the perseverance to ride the ups and downs of a startup and then be successful after doing that?
Yeah, I think to echo some of the other comments, to me, it's obviously, starting with the problem, so why, and then also why now? Like, why are you as a company in the position to win? And then it's really being able to get through your story in like 15 minutes. And because if you can't get through your story in 15 minutes, you're probably going to get stopped multiple times along the way, whether, as Humberto mentioned, let's talk about the intellectual property, let's talk about the clinical study, let's talk about XYZ aspect, the market. And so being able to go off script, and I think that's important, is that your story, your company so well that you can field any question about any aspect of your business, and engage in a dialogue, engage in a conversation. It's not just, I memorized my speech and, I memorized my pitch.
I think it's a little more than that. Like, I get 15 minutes, but what I loved about going through MedTech Innovator as a startup is they made you do it in one. Like, when you started, you had to do a 1-minute pitch, and that was probably the most difficult. They talk about getting your elevator pitch down, but doing it in a minute is really, really hard. 7 minutes is tough, and then when they give you 3 or 5, it's tougher and tougher. But a minute is probably the hardest. So simplifying it into a minute, I think, is really, really important. And if you meet somebody randomly wherever, to be able to, when they say, what do you do, actually tell them and have it be a meaningful discussion in a minute, I think that's really important to crisp your message to that.
And I think that goes back to boiling down the essence and the heart of, like, what is it that you do, what makes you innovative, what makes you investable, and so understanding kind of that ethos, that why do you wake up every day?
And I think a lot of times people miss on personalizing why they started the company or why they developed the technology. And when you ask them the question, a lot of times it's a really interesting story of somebody in their family who died of that disease, or there's some personal motivation that drove them to start the company. But a lot of times they forget to put that into the story, and I don't know why that's the case, but I always recommend people to add it back in.
And I want to bring it back to the topic of alternative capital, and we'll oversimplify it and have angels on one side and venture capital or institutional capital all over here. But we have some expertise on the panel with regards to family offices. And once again, if we use this psychology of being a first-time founder, you hear things that, family offices, reach out to family offices, but the big question is how? And it's often called silent money. And so you can think about, it's a bunch of uber wealthy rich people in tuxedos at a party, and you meet one of them and they might introduce you to all the rest of their friends, and that's basically how you get into silent money, because you can't find them on Google and you can't find them on lists and all that other stuff. It really doesn't work that way. So I really want to highlight family offices from both an LP side, if possible, and also from family offices making direct investments into startups. And I just want to layer one more thought on that, because it's a really interesting psychological piece where angel investors are making checks $5,000, $25,000, $250,000 possibly, but it's their money. And then on the institutional side, they're investing someone else's money. And then when you're talking about a family office that has sometimes the capital power of an institutional investor, but yet the emotional decision making like an angel investor, it really has a unique place on the spectrum. So I want to ask here is, when you have a startup that's raising a 5 or 10 million Series A and they're asking a family office for 1 million, and it's a 100 million or a 500 million family office, even at a 5x or 10x return, it's not going to really move the needle for that family office. So it's a completely different psychological set. And I just want to toss that open-ended question out to you is, where do family offices fall on the spectrum when it comes to investing in medical device startups?
I'm happy to start. So we are on the smaller end in terms of we are looking to deploy maybe 3 million annually. So we typically write check sizes of 500,000 to $1 million. So in any given 12-month period, we're doing 3 to 6 investments. So it is, we are, obviously we're invested, but I've got to think of a different word. We're emotionally invested in the companies that we're looking at. We want to really understand the companies. We want to be able to leverage our network to help grow the business and help them achieve whatever goals that they're servicing. In terms of, I think at the core of your question, Giovanni, partially is, how do I identify these individuals to go out and reach out to capital? And I want to come back to something that Humberto said earlier, understanding what historic investments a firm has made. I think, one of the best things you can do is go on Crunchbase and see who is invested in companies that look similar to you. In the same way that you are doing competitive research for, people that are competing in your space for competitive products, you can do the same type of research when it comes to who is investing in those type of companies, and that can be a way to surface leads that are a little bit more focused for whatever your area is. I understand it's hard being an entrepreneur, and I have not done it, but having spoken to many, trying to find the right people to reach out to and trying to tailor that message appropriately when you don't necessarily have a lot of background on the family offices, which I think, unlike large venture firms, the material that's available on these funds is going to be smaller. Seeing what they invest in can be, very illuminating in terms of where their focus areas are, what their check sizes are, and so on, in terms of making inroads into those companies.
On the LP side, I think the answer can be even a bit more complex. Because, for instance, the families that I've been working with for the past few years, 3 of them are larger than $1 billion size. And they give us the ability to invest from a few $100K up to several millions. So it's difficult sometimes to shape a specific answer, especially considering acting as an LP, because first thing we will ask is one of our funds already investing in that company? Why? How much money? Is the fund capable of doing follow-ons? Does it make sense for us to co-invest with the fund? Do we have the rights for co-investments with that fund, right? And usually for the VCs, like you mentioned, they have a specific mandate of what they are looking for. When you're acting as a family office, sometimes it's just one of the members of the family that are interested in that space. Sometimes it's something that is absolutely unpredictable because someone been somewhere, heard about it, and now it's interested because the entrepreneur is someone fantastic, right? Totally opportunistic, right? But sometimes it's their life's mission. One thing that I think it's interesting to add in that sense is usually those large family offices, they come from a large business, and everybody knows that business, right? So probably that business is a good way to start the way you think about that family office, because number one, probably that's the best way to access the family is through that company. Having a relationship with the company makes it a lot easier to reach to the family if you don't have any direct relations with the family. But at the same time, a big mistake that most entrepreneurs and even funds that I know they commit in that sense is that think that they should be pitching the family money for the businesses that could be complementary or competing against the original corporation. And usually good corporate governance dictates that the families, they should not be able to invest in anything correlated to the business, right? So eventually, if you're pitching a medical device for a family that made a lot of money in health space, probably not the best investor, because they're probably forbidden to invest in anything health related, right? So this is a tricky part that most people who never try to raise money with those families, they tend to miss.
So I'll add to that. I think, to Humberto's point, is once you know a family office, you know one family office, and every family office is different, right? As I think about the range of family offices, you have everything from, you have an active business or to an exited business, and or then there's a third kind of, especially these much larger institutionalized family offices, are generational wealth. Like the Rothschild family as an example, and they have multiple branches and multiple divisions. And I think the point, and then some of them have the first generation wealth generators are active in the decision making. In other cases, they don't. In some cases, like ours, my uncle sold a business. He asked me to help him, and then obviously, his wealth, my wealth, and my family on my dad's side. We've all basically syndicated, and we do deals together with yet another family that owns a large healthcare software business and invests alongside us. So I think it's very different. But the way I think to be successful is to understand what that family cares about. So in our case, we invested in stroke because, the father of another family office, he had a stroke, and it's an area that they're deeply passionate about. They weren't successful in, preventing long-term disability for their father, but they are interested in that space for the long term, for other families, for other patients. So I think, one angle is understand like what is affected, because at the end of the day, family offices are people. Real people like you, like me. We live our lives. Some people have jobs, some people don't. And some people are affected by disease, others aren't. Some people go and they're really interested in environmental stuff. I was with one of another family office last week, and he's like, we're doing all these healthcare investments, but my daughter, she really cares about saving the world and the environment, and so we're not investing in oil. We are not. We're only doing green energy. And he's like, I don't get it. I don't get green energy. He's like, healthcare, I feel like I get because, it has a social impact and I get a financial return. And so I think it's conversations like these where, you just have to talk to the individuals. And then I think you also have to understand, is that person on the other side of the table, are they a key decision maker, right? Is it their money? Are they writing the check? Are they an influencer? Where they are involved in the decision making, but ultimately it's somebody else's money, or are they an employee and they it's a higher job and they have to prepare an investment memo? So I think that makes it different in terms of raising capital from family offices, and also understand that family offices, unlike funds that have very systematic portfolio construction, we're going to do 7 to 15 investments, we're going to invest and deploy. Not all families are organized, so they might write you $1 million check in your Series A, and then that's it. There's no money after that. Others, they might write you a $100K check in the first, in the Series A, but then they'll write you a $5 million check later. And so I think understanding what their capability and capacity and interest is important as you take on family money, because it does come with a lot of emotion and a lack of structure.
Yeah, maybe if I can briefly add to that. So us as a government-backed fund, we co-invest with family offices quite a lot. And what we see is the great diversity in these family offices. But they're also really good to work with, because if you build that, it's really nice to build up a relationship of trust with them. And then what we sometimes see is that, and that's a tip for all the CEOs here. Sometimes it happens that they like to follow our DD, and because we're not a private investor, it's easier for us to share that with them. So we. Maybe there are some government-backed funds in your area that have a network of family offices or angels that they know well and that they can work with and that they can help you introduce make introductions to.
One thing that I would like to complement the answer is a few characteristics that are more or less common in terms of family offices. They tend to be more risk averse, with a lot of exceptions, of course, but they tend to be more risk averse. Revenues-wise, they tend to be way more patient. Acting as a GP or an LP, they tend to have way more patience than regular investors. And also, I think that there's a cool thing about raising capital family offices is that they are way more flexible in terms of shaping the corporate governance. So you can engage them and discuss and evolve throughout time the best way to build your governance.
Alberto?
I just picking out a personal experience. So one of the startups I worked for, our first check size was $10 million from a family down in South America, and they were in the beverage business and they invested in a cancer business. The question I have is, it feels like, in my perspective, that was very emotional. And I had to spend the same amount of time finding those family offices and pitching to VCs. I realize it's easier to pitch for family offices. Is that fair? Because my pitch, to be my experience, the grandma had breast cancer. So for her was the most important thing. For her, she knew all the structure behind what is the treatment of breast cancer, what is the problem with breast cancer. So when she looked at her device, she told the kids, I don't care, get it done. Is that fair? Or did I get lucky?
It can be.
You're biased.
Yeah, I mean, it can be, and it's, you know, we talk about emotion, right? And I think when it comes to, especially in healthcare, right? When that disease state touches your family, you care. Why? Because you have lived it. You have lived it, you've experienced it, you've seen the challenges, and whether you've made your money in oil and gas or in consumer packaged goods or retail or fashion, right? Healthcare is something that is common to all people, right? And disease affects all families. And so I think, yeah, it could be the easiest check, right, to get, but on the flip side is that, you know, it could also come with strings attached. You just don't know.
I think you're biased. I think for the entrepreneurs who are successful raising capital family offices, it will feel like it's way easier, right? For the rest of the entrepreneurs, way harder.
Do you have a question?
I think the question then for the audience, would you recommend then spending, let's say, 20% of the time figuring out who are the family offices, or 80% of the time figuring out, or going straight? Is there a ratio that you've been looking at on your fundraising experience, hearing pitches? How should these CEOs, you know, understand, because time is money.
Well, the one thing I'll say is that, like, finding family offices is not like finding venture investors, right? You can go, there are thousands of lists published, you can come to a conference like this, people are, you know, there are speakers on the panel, they're in the matchmaking platform, you know, they're out there. I think family offices are much harder to find, so it's very hard, you can't be systematic about finding family offices, so I think it's more serendipitous, you know, or also like by being at conferences like this, oh, you know, do you know any investors? It was kind of, I forget which panel it was this morning, but talking about if you talk to somebody, ask them, okay, who else do you think might be interested? And it could be, you know, a GP at a fund says, you know, I have an LP, they've, you know, we don't really focus on cancer, but they're really, you know, they care about cancer, or, you know, so I think it's all kind of word of mouth, really.
I think it depends on several things also to build that case. If you have something that is already growing and it's late stage and known, doesn't matter because VCs and family offices alike will be chasing you, right? But before that, I think that if you have a business that it's something that is in terms of regular venture capital investable, I would focus on venture capital because you have a lot of structured funds available for you to pitch. But in the other hand, if you're building a business that is something that it's odd for the majority of the VCs, most likely out of their investment thesis, then I think it makes a lot of sense to put a more effort on raising with family offices because family offices, they tend to be more flexible, right? So for instance, if you're building something that is really different out of what people are expecting for as a trend, tends to be easier to raise with family offices as opposed to the good and known VCs, branded ones.
I want to throw a question over to Mercedes, and more of like a general topic of either governmental or sovereign funds. And it could be in Brabant, which I wish I spoke better Dutch. I can actually say the whole acronym of BOM. Maybe you can help me out with that. But there's these government or sovereign funds in a lot of countries, maybe all countries. But what is, in terms of alternative capital, and you're in that country, or maybe there's even a tax incentive to open up an office in that particular country to receive those funds, thinking about from the entrepreneur's perspective of looking at, like we've been already talking about, family offices, angels, traditional institutional venture capital, but then there's government-backed funds, and what benefits come with that beyond the check? And how should entrepreneurs be thinking about looking in their backyard or other backyards for these government or sovereign funds?
All right, good question, thank you. So we can answer this two ways, or I can answer this two ways. One is, are you in the right ecosystem or not? Are there other ecosystems that could make your company grow faster, get to market sooner, get your supply chain the way you want it? So that is what we have to offer for certain companies, not for every company. We have a couple of things that we are really good at, like I said, surgical robotics, imaging, biomaterials. So if there is that fit, then it would make sense. If there's no fit, then it doesn't make sense to have that conversation, and then you need to look for another ecosystem. If there is government-backed funding where you are, and that you're in their focus, have a chat with them. The other thing is that you might not know is that one of the statistics in the Netherlands, so government-backed funds were involved in 60% of all VC deals in the Netherlands last year. We only did 10% of the money, but 60% of all deals. That means we come in early, but we stay in for a long time. We are patient capital. We don't have the usual 552 fund cycle. So there is that benefit as well. We see a lot of deals. We do a lot of deals, so we have a lot of knowledge on deal structuring. We have a large network, both national and international. Because of our patience, we stay in the companies for a long time, and at some point, they're going to need to raise a 30, 40, 50 million euro round, and then we engage international investors. We are operating like a VC fund, but we're not.
I think that's a great point, and that's a segue to understand sources of capital. So one of the things that as an entrepreneur you will look and where to get your money is not so much who's giving you money, but how can that person help you? And I think that's spot on. Like, Matt, maybe can you share like on the investments that you've done, like how out of your own way do you go to help them be successful? Are you willing to coach them? Are you willing to like open doors? Because sometimes when you're early on, you need all the help you can get. Like customer acquisition cost is the biggest problem.
Yeah, I mean, I think as I described earlier, we do a handful of investments annually. So we are very invested, you know, not just with our capital, but with our time in terms of growing the businesses that we are working with. Our advisory board, I think it punches a little bit above its weight, but you know, we typically are looking at deals, you know, back to the diversity of family offices and kind of somewhat of the lack of structure. We look for deals where our advisory board, and myself included, are able to add value both with our network and our connections and our expertise from where we've gone so far. We dedicate a lot of time. I'm thinking about kind of other capital sources, but I'm thinking of non-dilutive capital. Both the owner of Cedar Street as well as several of our advisory boards have been former Deputy Secretary of Health and Human Services for New York State, high positions in government within New York, not as politicians, but in terms of actually operating. And whenever we're looking at new opportunities, there is a lot of money out there through different agencies, whether it be federal or state. There's a lot of economic development money available. Maybe 5 to 7 years ago, the former New York governor wanted to dedicate $1 billion to Buffalo to bring back economic development within that region, which has kind of even our very fact of being in Malta, right? I mean, I believe the Maltese government has stated that they want this to be a MedTech hub. There is capital out there. You just need to do the work and dig and see what's available. And I think you can surface some of those opportunities by connecting with other entrepreneurs, seeing where they've gotten their funding source. But I guess to answer your question that you initially asked me, we put forth a lot of time in trying to help our companies that we invest in succeed.
Yeah, I mean, even accelerators, there's a lot of accelerators out there that do take something for doing the accelerator, but there are other ones like MedTech Innovator where it's all non-dilutive funding, so they're not taking anything. And it's all upside. And so when I talk to people about MedTech Innovator, it's the fund itself, the accelerator itself, it's all non-dilutive. It's over $1 million a year that they give out. But there's so much that they give. There's so much to get out of the program and the network. I can't imagine not doing it as a startup. So a lot of startups say, oh, accelerators, I've been through a couple, but they haven't been through ones that are at that level. And then the other thing I'd say is a lot of these accelerators now, including MedTech Innovator, have funds on top of the accelerator, which is another alternative source of capital that you can get funded by. So I think it's paying attention to what's out there, but especially the non-dilutive funding from BARDA, from the NIH, from all kinds of different government grants. There's a lot of paperwork involved a lot of the time. But again, they're not taking any equity from the company, so it's worth the time and effort if you can get that funding.
Yeah, also I think we've structured a lot of deals where there's a high non-dilutive component, so we know how to navigate the local opportunities, but also the ones in Europe. And with respect to the accelerator, we also we developed a venture building program, which is now rolled out nationally. We span it out into a company, actually, and that runs as an accelerator program, which is free of charge for the companies in our region. It's now it's offered nationally by the other regional development agencies, and there is a lot of research just made public that companies that go through an accelerator raise their Series A much faster than if you didn't.
Yeah, I mean, if you think about the judges that are in those accelerator programs, especially if it's one that's like a MedTech Innovator where J&J is the biggest funder of it, you've got major MedTech executives that are judging, you've got venture capital guys that are judging, you've got corporate venture people from the biggest med device companies out there that are all judges looking at the company. So in terms of getting capital faster, getting even acquired faster, your likelihood changes if you go through one of the bigger, more interesting accelerators like a MedTech Innovator.
And I want to spend some time before we wrap up with this idea of alternative theses. We talked about how to develop a venture capital thesis in portfolio management earlier today. We've talked about alternative capital in terms of a spectrum of who and what could be a potential investor. But Omid, you mentioned that earlier on you had a thesis that was going after the value of death. And I think there's no shortage of entrepreneurs who start crying very loud at that level of saying, okay, it was hard enough early on to get my early cash, but now I'm going through a pivotal trial or clinical studies, and I need more data, but I need funding to get more data because I'm not even close to FDA clearance or commercialization to be able to have the extra information that they need for the bigger rounds, right? So this alternative theses that you've developed, how do entrepreneurs find that? Like, how would entrepreneurs know that you're looking at the Valley of Death? Are they Googling that? How would they know that you have to be an alumni and actually apply and go through the whole thing of going through MedTech Innovator? Let's talk about the alternative theses that have been developed.
Yeah, so I think part of the shift in theses, I think also depends on where you are in the cycle, right? And on another panel, we heard about this shift from everybody moved out of medtech because they were going to biotech. You could take a company public with little to no clinical data, and it was worth hundreds of millions, if not billions of dollars. I think the other thing is there's been a selection bias when it comes to funds in medtech, where the successful funds have to raise more money to stay in business. So it's the economics of fund management, which is, you start as a $50, $100 million fund, you take early stage risk. Some folks on the panel earlier this morning said, hey, we realized it takes a long time, that's why we move later. Other funds have kind of stuck to their knitting where they invest early, but they only deploy a third of the capital up front and hold for the long haul. And so I think it changes based on where we are in the cycle. I think right now, post 2021, 2022, 2023, I think a lot of firms have become a bit more reserved in terms of deploying capital. There are a lot of funds sitting with quote unquote dry powder, money that they can invest. But given the turn in the public markets, going sour, the closing IPO window, I think a lot of investors are looking for value in this environment. And so I think one of the challenges raising capital in the next 24 to 36 months is finding the investors that aren't just financially driven or they don't have some mandate. And that means talking, right? You have to reach out to, I think someone said they reach out to like 88 funds to get 2 term sheets. That's actually pretty good odds, right? Normally you'd be talking to 200 or 300 to get 1 term sheet. And so I think just having the conversations, talking to investors, if somebody's not interested, saying, who do you think would be interested? Because people come up to me all the time, they're like, hey, we're doing X, Y, and Z. I'll either say, oh, it's too late for me or it's too early for me. But if they ask me, I'll say, well, go talk to these 5 funds or these 3 family offices that have an interest. So I think it's that networking and having the discussions.
I think you can even use that question as a due diligence process for the entrepreneur selecting the investors. You can ask the angel investor, an angel network, or the VC, who else can you bring along for us to try to pitch and bring more money? Can you make introductions among family officers? Most VCs, especially the good ones, the branded ones, they already have family offices within their investors. So it's always good to ask and try to build that big picture of who else is coming along with that specific investor that is already backing your business.
I have one punchline, last question for me, but in case you have one, Alberto, go for it.
Maybe I can just add a final point to adding sources of alternative capital. One thing that I hope I'm not stealing your punchline, but one thing we haven't discussed yet, if you have a diversified shareholder base and if you get alternative capital in, be aware of the different interests of your shareholders around the table and make sure you discuss that openly or not if that is in your strategic interest. But be aware that family offices or government-backed fund may have different timelines than VCs that you might have in or get in. So be aware of that.
Last one, so alternative capital. We've talked about the spectrum itself, objectively speaking, but I'd like to also talk about alternative geographies, and I'm going to be overly general here. We're in Europe right now. We often talk about the United States in these 2 major areas, but we've also talked about Chinese capital. We're lucky to have Humberto with us today. In your quick 1-minute spiel, why should Latin America also be on the map for international companies looking at money from Latin America?
My take for that is that because there's tons of money in Latin America, people don't realize how much money is restricted currently in local investment there that could be being deployed globally. And number two, probably those very same families are the best way for you to sell and enter the markets in Latin America. If you raise capital with a big tequila family from Mexico, we'll help you out on almost anything, right? Same in coffee in Brazil, in poultry, and you name it, right? So I think it works both ways. Not only access to money, but probably the guys who have money to invest in your company out of those geographies, they also can open a lot of doors and opportunities.
And I know it's a very complex answer, but if you can streamline it, for all those entrepreneurs out there in the US or Europe or Israel who are developing the next transcatheter heart valve, and they do want to meet the family offices or businesses in Latin America, is there even a way to find them? Or how would you go about even trying to start those relationships if you have no clue of where to start?
You can call me.
Thank you very much. I want to say thank you to the panelists. This is Alternative Capital, and hope everyone learned a little bit of something new.